Welcome to Key Points for November. This month, why we think the rout in equity markets will soon be coming to an end, why we think the policy action by the Chinese authorities is quite profound, and why we think that the upcoming earnings season is likely to be robust. Now, turning to our first point, a lot of you will remember that we cut our tactical overweight in equities in half at the end of August. This was because we felt that the typically challenging autumn period would likely once again throw a few hiccups in the way. And indeed, that's what's happened. To be fair, the rout in equities has been more severe than we had anticipated, and we think that's led to oversold conditions developing. When we look at the cycle, we don't think it's yet over. When we look at some of our tactical indicators, it implies that investors have become too bearish. And we look at the fundamental backdrop in terms of valuations, we've seen significant compression, meaning that a lot of our equity markets are now offering quite attractive valuations. Now, that in itself is not enough to create a rally, but we do think given these oversold conditions, as we get into November and December, we're likely to see a bit of a rebound coming through. The cycle is not yet over. Now, turning to our second point, there's been a lot of concern, as there often is, about the Chinese growth rates and if they would have a hard landing or not. Our view has always been that this will not be the case, but indeed, growth has been slower than we felt the Chinese would like to see. And indeed, as a result of that, there's been quite a significant stimulus drive in recent weeks. Now, this is, of course, important because the Chinese wanted to double the size of their economy in terms of GDP between 2010 and 2020. And as a result of that, we believed that they would do all they could to support the growth rate into 2020 to achieve these goals, something that we think is definitely achievable. But it's important from a market perspective that the recent stimulus, cutting the reserve requirement ratios, providing additional tax cuts for consumers, and doing some infrastructure investment will be enough to keep the Chinese growth dynamic in place for, we think, a number of quarters still to come. A positive, again, for markets. Now, turning to our last point, earnings. The last two quarters have been very good from an earnings perspective. In the US, we've seen 25% or thereabout in both Q1 and Q2. And we think Q3 is likely to once again be a very strong period. Earnings in the US, so far we've seen some tentative signs that this is the case. Margins are holding up better than many had expected. And even in Europe, which has been typically lagging in terms of the growth rates, we think we'll see high single-digit numbers coming through for Q3. Now, all of that together, in addition to what we think are oversold conditions for markets, we think should cheer investors from a fundamental perspective and support what we think will be a pickup into year-end for equities. Remember that the full details of everything I've said today is available in our Investment Insights for November publication, which, along with all our documentation, is available on zurich.com/MSME.